Hello and welcome to your Property Empire. I'm Dan Murphy. Research shows that 80% of property investors are underclaiming their depreciation entitlements. Did you know that not maximising your depreciation claim could cost you thousands of dollars? Well, on this episode, we take a look at property depreciation and how it will affect your cash flow position. We also have our regular segments with Tom Panos at News Corp and Charles Tarbey from Century 21 will be joining us to share the latest property numbers from around the country. But first, joining me tonight to share his expertise is Brad Beer from BMT Tax Depreciation. Brad, a warm welcome to the show.
Thanks, James. Good to be here.
First of all, just talk us a little bit, just explain to us exactly what you do at BMT and also, I guess, the importance of maximising depreciation deductions.
Yeah, well, look, at BMT, what we are is quantity surveyors traditionally, and what we do is we estimate construction costs, as in we count bricks and tell you how much they should cost to put there. Part of that is we get involved in this property depreciation, and property depreciation is something that investors will use to help get the maximum cash flow or tax returns out of those properties that they invest in. So a bit like when you buy a car, it kind of wears out over time, and if you use that for business or for investment in some way, or usually business that is, you'll be able to claim claim part of that depreciation against the income derived from that business. Property kind of works similarly because things in that property wear out over time. Your carpet wears out one day, and the building itself wears out, and the bricks and mortar eventually. And so the tax office says if you use it for investment, we'll allow you to claim a deduction based on that wear and tear in that property. Now investors are buying property with the purpose of making money from properties. So people sometimes think that is a little bit odd because we're buying property to appreciate in value, but your carpet's still going to wear out. So even though you're buying property and the overall value of the property, largely the land value, is appreciating, the actual carpet and things in the property are actually going to wear out one day. The tax office says to us, well, we'll allow you to make a deduction for those losses, and what it means is really more cash for that investor. It's a deduction that you don't have to pay out, so it's a non-cash tax deduction. So it's not like there's a lot of expenses with properties that you pay out, and then if you make a loss, you get a deduction for those. But depreciation's tapping into a non-cash or non-paid out tax deduction that it's the wear and tear on the building. You're not paying for it each year, but you get to make a deduction for it. And we'll get in to see that it actually means quite a substantial amount of money. And as you said, 80-odd% of investors, with some research we did, don't claim it all properly because they don't really understand it very well and don't get the correct advice.
So how does it affect your cash return?
Well, we work out exactly an amount of deduction, and whatever that deduction actually is, which relates to the actual property, it's a direct deduction against, well, your other income. If the property you've got, you've got some income coming from rent, etc., you've got some expenses in relation to that property, it'll end up in either a positive or negative situation. This is another deduction you get to add it. If we've got a $10,000 deduction and you're on a 30% tax bracket, it'll be $3,000 in your pocket. For 48 cents in the dollar or the highest tax bracket, then it's nearly half of the money actually back in your pocket at the end of the year. So it makes a fair bit of difference to the cash flow.
So when can it be applied?
Applied is, well, you get to claim it every year. So before you buy a property, you really should look at crunching your numbers on that property. Can I afford to own this property? You can work out your interest and a lot of those costs pretty easy. You can work out what sort of rent you should get from that property roughly, insurance and things that you've got to pay for that property. But one thing you need to know is how much is this depreciation going to be, so you can actually calculate for you in your position what that sort of deduction might be. So before you buy it, you should crunch the numbers. Calculators, or we can talk to you at that early stage if you want. The other thing is, once you've bought the property is when these deductions actually make sense. So that's the time when you need to get those deductions worked out and make sure in that claim at the end of the year you've included them.
So that's why it's so important. So does it work equally on units and houses as well, same principle?
The principle's the same. The difference is the claims that you make have a relationship to the construction cost and also to the value of all of these items in the property. So when you buy a unit, you're usually buying a bit more construction cost, I suppose you would say, because you're not buying land value. When you buy a house, you've got a bit more land, and that's part of usually your purchase price. The age of the property also impacts. So a new or an older unit, there's some differences, but works for both in the same principles. But a unit at the same purchase price will usually end up with a few more deductions because there's more construction. And there's also all the common areas in a unit complex. You own part of the lift, the underground car park, the driveway, any of those sorts of things. You own your piece of those, so you get to claim your piece of those in this depreciation. So that helps push the numbers up as well.
Okay, and does an accountant look after that most of the time?
So that's the common myth, I suppose. And when people say I'm a quantity surveyor who do depreciation schedules, they kind of look at you funny a lot of the time. And we're a specialist in that depreciation only. So we work alongside the accountant. Most of the time, the jobs that we do come referred from the accounting industry. So people buy investment properties without really understanding some of these things, and if their accountant is up to speed, they'll say you need to get a specialist in for this part. So we kind of, because we're the cost specialist, we kind of know what we're doing. We actually visit the property so we can estimate and count the bricks if we want to, and look at the condition of everything in that property, put values on all those things in that property, so we can work out these real numbers and also maximise these numbers so you get as much as you can out of that property. Our reports are used by the accountant as part of doing the tax return for the client, but we work alongside them. We give copies of the report to the accountant and they use our numbers in part of that tax return.
And Brad, you've brought along an example for us tonight as well. This is an example of depreciation in a new house. Just explain to us what we're seeing here.
So in a new property, we've got a new house here bought at $550,000. Now, in this situation, we've got deductions in the first year of about $14,500. So depending on your tax rate, and in this scenario, we've run a tax rate of 37 cents in the dollar, and we've got about $6,500 in deductions in the first year. Sorry, what we've got is $5,365 in cash back to that person in the first year. Now, if you look at that, that's about $100 a week in difference in the cost of owning that particular property there after your tax position's been done. Apply depreciation properly and get those numbers, that $14,500 in deduction. If you're on that tax rate, it's $100 difference in the cost of owning that property. Now, rental is something that you can only get a certain amount for the property. You can't go and put the rent up $100 a week or it'll be vacant next week, unless that's because you can only get the market rent for properties. This is kind of something that so many investors don't do properly, and in that scenario makes $100 a week difference to the cost of owning that property. So I can't understand why you wouldn't, but it's largely due to not knowing or understanding that it needs to be done properly.
We're going to be getting more insights on depreciation with Brad Beer later on in the program, but now it's time to take a look around Australia and see what properties are up for sale this week. For more, Tom Panos from News Limited joins us in our Sydney CBD studio. Tom, hello to you. What's hitting the papers this weekend?
Okay, Dan, how you going? Hi, Brad. We've got a property at 79 Warimba Street in Warimba. For a lot of the people out there watching the show right now, maybe they haven't heard of this suburb. It's not a suburb that comes up very often. I can tell you that this suburb is in the inner west of Sydney. 2-3 years ago, I think was ranked by one of the data companies as the fastest growing suburb in Sydney in terms of price growth. And Dan, this property here is immaculate. Very rarely do you get a home that's newly built there because they're all traditional homes, usually of Federation era. But this home here is near new, 1 year old, a significant home, substantial home. It is presented to you by the owner of the business of Rain and Horney and Five Docks, Sam Varica. He's been managing this property from day one. Our vendors have gone with that real estate agent Sam there, who's sold a number of properties in that area, and he's told me what stands out is architecturally designed home. It's large, it's quality, and it's got a price guide of around $2.5 million, Dan.
Okay, looking at that one pretty closely then. Of course, Tom, also interest rates didn't go up this week. Let's get your views on this. What do you think the impact of the RBA's decision will be on the real estate market? What have you been, I guess, talking to some of your clients about?
Yeah, Dan, it's not going to make much of a difference. The demand, the pent-up demand is so high. The marketplace is a marketplace where there's simply not enough stock for the amount of buyers out there, particularly when we talk about Sydney, Melbourne, and then to a lesser extent other parts of Australia, a super strong market. Even in Adelaide, where it's normally doesn't have the energy of say some of the other major cities, we are talking about a very strong market. Now, whether the rates are going to go up 0.25% or they're going to go down 0.25%, at the moment there is so many purchases out there that it's really not going to make too much of an impact.
And Brad, were you surprised by the RBA's move?
Look, whether I'm surprised there or 0.25, I think the interest rates don't seem to have been the trigger to slow the market down that I think the RBA used to be able to do, or not quite as fast. Doesn't seem to have the impact at the moment because they're really low. I mean, they're really low, so people are still acting. Like we deal with investors. Investors are a large portion of the market buying properties at the moment, and there's lots of investors buying property. There's more than normal. Look, a little bit, you know, surprised or not surprised. It's the concern that I think, though, I suppose, is that I've been in the property market buying properties for probably about 15 or so years, and I've never been through really high interest rates, but I have been through 7s and 8s, and it's a big difference in the cost of an expensive property. So if you haven't been in over 5s, then the cost to own property per week is quite different. And I think looking at the cost to own it now versus the cost to own it if it was a little bit higher is something that anyone buying and paying, you know, high prices needs to really consider.
And I guess, Tom, are you concerned about some of the heat that we are seeing in the Sydney and Melbourne market? And do you think that there's anything apart from interest rates that the government can do to slow the market in those parts of the country?
Yeah, Dan, it's an interesting dilemma that we've got, because the reality is that for lots of economic reasons, rates need to be kept low. But then you've got the issue, of course, which is the Sydney market and to a less extent the Melbourne market, which are super hot. So you can't actually turn around and say we'll play with rates just to affect one marketplace. I don't know. There's various things going on. You hear about legislation where they're going to make it more difficult for people from overseas to try and buy property. Will that help? I'm not quite sure, because the amounts of these application fees and the costs involved and the hurdles involved aren't significant when you're seeing that a lot of Asian, people that are buying properties, we're talking about $1 million, $1.5 million, a $10,000 surcharge is neither here nor there. I'm not quite sure. There's been talk about maybe looking at the way that gearing rules are working. They've been thrown about. So I'm really not sure whether there's anything at the moment, because I can say to you this, Dan, we've got in Sydney, for instance, you've got a situation where people want to be living within 5-10 k's of the city, and they'll choose to live in a smaller unit than a larger house, like an hour or 1.5 hours out. Our issue is that we've got a lot of people that want to be in small sectors of the whole land that we've got in the country, and I think that's going to continue, because you ask the typical young person, they want to be living near the city.
That's exactly right. Tom, you did mention those foreign investor rules. Do you think, I guess, the concern that we've seen this week about some of those changes is founded?
I think the government would like to see that they want to be perceived as if they're doing something. Whether those actions that they've taken are going to actually have too much of an effect, I would be very highly sceptical, because as someone that auctions real estate on a Saturday, and we're talking about prices of $1.5 million, as I said earlier on, Dan, I don't think a fee of $10,000 or even $15,000 or whatever fees that they bring in, I think you've got to make it considerably more than that, or put larger hurdles, because Sydney is still very, very attractive. I mean, to give you an example, houses go up by $25,000 in one bid on a Saturday, in 1 second at an auction. I don't know what $10,000 surcharge is going to do to stopping someone buying.
All right, Tom, really appreciate it. Thanks so much for your analysis on your property empire, as always.
Thank you, Dan.
Well, time to take a very quick break. When we come back, though, we're going to be taking a closer look at how depreciation works for older properties. You're watching Your Property Empire. Stay with us. Welcome back to Your Property Empire. I'm Dan Murphy and I'm joined by Brad Beer from BMT Tax Depreciation. And on this episode, we're discussing depreciation and how to make it work for you. Brad, thanks again for joining us. How does depreciation work for older properties? Before we went to the break, we were talking about how it works on new properties. Tell us how it works for older properties.
Well, Dan, on older properties, I guess the concept's quite similar. It's a claim against on the wear and tear against items in the property, but there's a few rules that kind of change how much deductions there are. A lot of people sort of believe I'll call it a myth, that old property doesn't get depreciation, or that it has to be new, or has to be less than a certain number of years old. And that's not the truth. The truth is that older property doesn't get as much deductions, so it's not as, I suppose, lucrative and doesn't make as much of a difference, but still gets some deductions. There are some properties that don't get deductions, but age is not the only question that needs to be asked. There's a few other questions that need to be asked as well, so let's look at it and see what you can claim. Now, the reason that age matters is there's, I guess, without getting too technical, there's two parts of depreciation, and one, you get to claim a 2.5% of the structural cost of the building, which is kind of on the floor, walls and roof. We estimate the cost of that structure and you get to claim a deduction against that structure. In order to claim that, a residential property needs to be built after 1987 now. So the age does matter with that part of the deduction, but the other part of the deductions is for things that we call, or the tax office calls actually, plant and equipment, fixtures and fittings, things like carpets and hot water services and blinds and stoves and curtains. And because those things don't last as long, the tax office allows us to claim them quicker. But there's no sort of special age dates on these things that says you can and can't claim a deduction for them. However, if the carpet's been there since 1927, it's pretty hard for me to put a value on it. Most properties that you buy that are old have had a lot of these things replaced by someone at some time. So if you buy a property now, we ask a few questions about, well, not just how old the property is, how old's the carpet, how old's the hot water service. And the other thing, has someone done some renovations to the property? Because that also makes a difference to the claims, because you add more things to the property, there's more things there to claim or to depreciate. So, you know, old is not the only question. Old, and how old is all the stuff in there, and has anyone done any work on it? And everyone loves to renovate these days especially. So really old properties with nothing done that you've owned for a long time sometimes are hard, but we'll always look at the individual property, and old property still gets some deductions, yes.
So let's take a look at an example. We've got a schedule for an older house. Just explain to us what we're seeing here, Brad.
Yeah, we've got an older house here, and it's been purchased at a price of 500 and I can't quite see those numbers, $430,000, and it doesn't get as much as those new properties we looked at, but it still gets a deduction in the first year of about $6,100, and we looked at the other ones and they're sort of $14,000. But this is an older house that we still found some deductions in. There's, you know, $75,000 worth of stuff to claim in total. In the first year, there's $6,100, and $2,251 is the cash amount that an owner of this property will get back in their tax return at the end of the year, providing they're on that 37% tax rate or marginal tax rate. Now that's still sort of, you know, $50 odd a week difference to the cost of owning that particular property. And a lot of people think, well, it's old, so maybe I won't get something, but it was $50 a week. You know, it still actually makes a difference in this older property and the deductions you get. The other thing probably to note is we talk about it's $50 a week, and I've got here that it's $2,200 in the year, and you do it the year. But you can actually get these things adjusted through the year as well, and it actually makes a difference. So you can get the employer to take less tax out of your income throughout the year, as opposed to just at the end of the year. So you can actually sort of put that cash in your pocket on the way through the year instead of just at the end. Your accountant will help you to do that.
Plenty to keep in focus. Let's get a bit of a pulse check on the latest property statistics from around Australia as well. Now we're joined by Charles Tarbey from Century 21. Charles, warm welcome to you. First of all, take us through the national auction clearance rates.
Yeah, hi, thanks Dan, thanks Brad. Look, the clearance rates have actually been really steady for quite some time now. I know a lot of the auctioneers are encouraged by that, but they achieved a 76.4% auction clearance rate overall. But, you know, when you look at it from this time last year, it was 74.2%. Not a lot of difference. Your best performer is Sydney at 81.4%, Melbourne at 77.1%, but a couple of surprises this week, being Adelaide and Canberra. Both of those achieved great results. Adelaide at 76.7% and Canberra at 74.6%. So all round, all pretty good. good results for the real estate agents.
So Sydney's still heating up. What about homes advertised for sale?
You know, that's an area that we really need to keep working on. 3.34% increase this week in Australia across this time last week, but we're still 2.9% down over this time last year. So the stock levels are still low, but they are climbing. And I know the guys were talking about, Tom was talking about earlier, the demand. The demand isn't everywhere, but it certainly is where we need more stock. The New Zealand market was negative this week, a negative 4.7%, but they've had a massive increase in stock over the last few weeks. So they're doing okay, but if they don't start getting some stock in, they won't meet the demand for their season, which is happening right now, and that could cause some problems there as well.
And residential rent price movements?
Yeah, that price movement has been steady, keeping the chart again from the start of the year. If I look at three capital cities this week, in Sydney, Melbourne and Perth, the Sydney market itself had a slight increase of 0.15%. WA was 0.19%, but it was negative 0.42% for the rents this week over last week. But when you look at it overall, we had a total, with all of the capital cities involved, a plus 0.73% increase in rent. But for this time of the year, it's still negative over the start of the year by 0.48%.
And residential vacancy rates?
They've been pretty good all around the country. Perth has been the one that's bothered me the most. 1.27% for Sydney, Melbourne market 3.28%, and the Western Australian market at 6.68%. The average over those three capital cities is 3.74% in terms of vacancy rates. So quite steady, quite steady. Brad, you owe me lunch, by the way, too. I'm waiting for that lunch.
Okay, Charles.
Charles, always appreciate it.
Yeah, that's right. I'm getting dinner cooked by Henry Lowenstein tonight for me, so at least I've got to start. So I'll see you next week sometime.
Enjoy.
Thanks again, Charles. We'll speak soon.
Thank you.
And Brad, just before we go, we have been talking depreciation on the show. Our viewers who are interested, where can they go to get more information?
Look, website to start with. It's www.bmtqs.com.au, and there's a lot of information about specific things that we've talked about, and there's also lots of YouTube clips that I've done and full training sessions and case studies on YouTube or otherwise that explain exactly how it suits for different types of properties. So plenty of information there on all different things about depreciation if you really want to read them all.
Well, Brad Beer, thank you so much for joining us on Your Property Empire. Appreciate it.
Thank you.
It is time to take a break. Thanks so much for joining us on this special show on property depreciation. Chris Gray will be back in the chair next week. I'm Dan Murphy. Enjoy your weekend.